Bonjour tout le monde, je vous souhaite la bienvenue. Good morning, everyone. My name is Paul Bodicher. I'm the Director of Media Relations here at the Bank of Canada. I'll be moderating this press conference about today's interest rate announcement and the publication of our monetary policy report. Le gouverneur Macklem va prononcer une déclaration préliminaire et après on va tourner aux questions. After his opening statement, Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions. So I will turn it over to Governor Macklem for his opening remarks. À vous la parole.
Good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss today's policy announcement and our monetary policy report. Today, we maintained our policy interest rate at 5%. We are also continuing our policy of quantitative tightening. Our message today is twofold. First, monetary policy is working to relieve price pressures, and we need to stay the course. Inflation is coming down as higher interest rates restrain demand in the economy. But inflation is still too high, and underlying inflationary pressures persist. We need to give these higher interest rates time to do their work. Second, with overall demand in the economy no longer running ahead of supply, Governing Council's discussion of monetary policy is shifting from whether our policy rate is restrictive enough to restore price stability to how long it needs to stay at the current level. Notre message aujourd'hui est en deux volets. Premièrement, la politique monétaire est en train d'alléger des pressions sur les prix. Ce n'est pas le moment de changer de cap. L'inflation ralentit parce que les hausses de taux d'intérêt limitent la demande. Mais l'inflation reste trop forte et il y a encore des pressions sous-jacentes. Il faut laisser les taux plus élevés faire leur travail. Deuxièmement, maintenant que la demande ne dépasse plus l'offre, nos discussions ne visent plus autant à déterminer si le taux directeur est assez restrictif pour rétablir la stabilité des prix, mais combien de temps il faudra le maintenir au niveau actuel. Laissez-moi vous donner un peu de contexte et vous parler des implications pour la politique monétaire. Uh-oh. Little problem. Missing a page. Merci. OK. Je vais reculer un peu. Laissez-moi vous donner un peu de contexte et vous parler des implications pour la politique monétaire. La croissance mondiale a ralenti, mais pas autant qu'on le pensait. C'est en grande partie à cause de la résilience surprenante de l'économie américaine. L'inflation recule dans la plupart des grandes économies, mais elle est encore trop élevée. Elle ne va probablement pas retourner aux cibles des banques centrales avant 2025. In Canada, economic growth stalled in the middle of 2023. For many Canadians, the combination of higher prices and higher interest rates has been difficult. But past interest rate increases have helped the economy rebalance, and this is relieving price pressures. Lower energy prices and improvements in global supply chains have also helped to bring inflation down. Growth is expected to remain flat in the near term. With weak demand in the economy, upward pressure on prices should continue to moderate, and inflation is expected to ease further. The share of CPI components that are rising faster than 3% has declined substantially and should continue to normalize. But tightness in some parts of the economy is continuing to hold inflation up. The most prominent of these is housing. Inflation in shelter services remains high, close to 7%, because of rising mortgage interest costs, higher rents, and other housing costs. And while food prices are not increasing as fast as they were, food price inflation is still about 5%. Finally, inflation in services excluding shelter has improved, but there are signs that price pressures remain. All this push and pull on inflation means that further declines in inflation are likely to be gradual and uneven. That suggests the path back to 2% inflation will be slow and risks remain. Overall, our outlook for growth and inflation is largely unchanged from the October report. Economic growth is expected to be modest in 2024, weak in the first half before picking up around the middle of the year and rising to about 2.5% next year. With downward and upward forces largely offsetting in the near term, CPI inflation is expected to remain close to 3% over the first half of this year. It is then expected to ease to about 2.5% by the end of the year and return to the target in 2025. In 2 weeks, we will release our summary of deliberations, which provides more detail about our monetary policy discussions. But let me give you a sense of that discussion. As always, Governing Council was focused on the decision at hand, the current policy rate. And there was a clear consensus to maintain our policy rate at 5%. We did, of course, discuss where we see the economy and inflation going and what that could mean for monetary policy going forward. What came through in the deliberations is that Governing Council's discussions about future policy is shifting from whether monetary policy is restrictive enough to how long to maintain the current restrictive stance. That doesn't mean we've ruled out further policy rate increases. If new developments push inflation higher, we may still need to raise rates. But what it does mean is that if the economy evolves broadly in line with the projection we published today, I expect future discussions will be about how long we maintain the policy rate at 5%. Governing Council is concerned about the persistence of underlying inflation. We want to see inflationary pressures continue to ease and clear downward momentum in underlying inflation. Si la situation change et que l'inflation repart à la hausse, on pourrait devoir remonter les taux. Mais si l'économie évolue généralement comme dans la projection aujourd'hui, la question va être combien de temps le taux directeur doit-il rester à 5%? Le Conseil de direction est préoccupé par la persistance de la forte inflation sous-jacente. On va voir les pressions inflationnistes continuer de s'alléger et l'inflation sous-jacente baisser de façon durable. We also discussed the risks to the economy and inflation. We're trying to balance the risks of over and under tightening. We don't want to cool the economy more than necessary, but we don't want Canadians to have to continue to live with elevated inflation either. We remain focused on a number of indicators of underlying inflationary pressures. We need to see further and sustained easing in core inflation. With the economy now looking to be in modest excess supply, demand pressures have abated. Corporate pricing behavior has continued to normalize. At the same time, measures of near-term inflation expectations and wage growth suggest that underlying inflationary pressures remain. Let me conclude. We've come a long way from the peak of inflation in 2022. Monetary policy is working, and we need to continue to let it work. We remain resolute in our commitment to return inflation to the 2% target. And with that summary, Senior Deputy Governor and I would be very pleased to take your questions.
Okay, thank you, Governor. Let me just quickly go over the ground rules. We have a pretty full house here in Ottawa and some reporters on the line as well, so I'm going to start here in the room. I'll ask everyone to please limit yourself to one question to maximize our chances of getting to every media outlet. If I forget to do so, please state your name and affiliation. Avant de poser une question, veuillez vous identifier si je ne l'ai pas fait. Et comme d'habitude, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's start here to our first question in Ottawa. I'm going to call on Steve Shear from Reuters, please.
Morning, Governor.
Morning, Steve.
You say there was a clear consensus to hold rates today. I wanted to ask you if anyone advocated for a cut, and is there any sort of broad timeline for when we might see a first interest rate cut?
With respect to the decision about what to do this morning, the focus across the council was very much on holding. I think there's a clear sense that, yes, inflation is coming down, but we remain concerned about the persistence of underlying inflation. Monetary policy is working, but we need to let it keep working. And in that regard, there was a clear consensus to hold at the current policy rate. Going forward, as I outlined in my opening remarks, today we published our forecast. And what do we get out of the forecast? The forecast is really focused on where's inflation going and what do we need from monetary policy to get inflation back to target. And that forecast has increased our confidence that we have raised the policy rate enough to get inflation back to the 2% target. When you look at the indicators, we've seen some progress, but that progress has been uneven. And as I said, we're concerned about the persistence in underlying inflation. And what that means is that it's premature to discuss reducing our policy rate. The discussion, our deliberations are shifting from whether we've done enough to how long we hold. But there was a clear consensus. It's premature to be discussing cutting our policy rate. We need to see more progress before we have that discussion.
Thank you. I'm going to go to Randy from Bloomberg now, please.
Good morning, both. Can you give us an update on the expected timeline for quantitative tightening, and are you expecting to have to make any changes to that?
As I said earlier, we maintained our policy of quantitative tightening. Our primary instrument for monetary policy is very much the policy, our overnight interest rate, the policy interest rate. With respect to quantitative tightening, we'll take it one decision at a time, but what would be the factors that would lead us to end quantitative tightening? Obviously, our balance sheet is gradually declining. At a certain point, it'll reach a more normal level, and it'll be time to start purchasing again to keep our balance sheet at the size we need. We put out some estimates about where we think that might be. Those are estimates. We're still some ways from there. As we get closer, we will certainly be continuing to refine that view and engaging with market participants. And I can assure you, as we've done every time we've changed policy with respect to our balance sheet, we will get out ahead of that and indicate, how we would likely do that. But we're certainly not there yet.
Thank you. I'm going to go to Raul from Epoch Times, please.
Thank you for taking my question. Does the Bank of Canada feel that it has engineered a soft landing in avoiding a recession, and especially given the strong growth projected for 2025, which was previously projected? We had recession calls kept getting pushed further and further into the future, and so with the rebound projected in 2025, I wonder if that's not too premature. If you could speak to that, like given that rates would still be quite restrictive in 2025. So just wondering how you can have the economy grow, 2.4%, even with still relatively high rates.
Well, with respect to our projection, it actually hasn't changed that much since October. Right now, growth has stalled. It stalled around the middle of last year. We expect growth to continue to be close to zero. Well, we don't have the Q4 yet of last year, Q4 of last year, Q1 of this year. And then we expect it to gradually pick up over the course of the year. That is very weak growth. And when you're projecting something close to zero, it could be some small positives, it could be some small negatives. As you indicated, we're not forecasting a a deep recession. We don't think we need a deep recession to get inflation back to target, but we do need this period of weak growth. And what that has done is it has allowed supply to catch up. So we are now in, we think we're now in modest excess supply. So those demand pressures on inflation have abated. And that's certainly one of the key indicators we're looking at as we assess monetary policy going forward. With respect to the projection, if you look at the monetary policy report, it goes through the various components of demand that explain why the economy picks up. As you move later into 2024, we expect global growth to start picking up. Most importantly for Canada, U.S. growth picks up. That increases demand for our exports. Consumption starts to recover. The combination of that and investment and stronger exports starts to boost investment. And at the same time, if you look at our projection, because there's excess supply, inflationary pressures are diminishing. So you get, inflation gradually moving back towards the target through the second half of the year while growth is slowly picking up.
Okay, next on my list, I have Mackenzie Gray from Global News, please.
Hi there. In the monetary policy report on housing, you talk about structural supply challenges, but also strong underlying demand from population growth, kind of keeping house prices at an elevated level. This week, the federal government announced a 35% cap on international students coming to the country over 2 years. Do you think that will have a material impact on either house prices or rents across the country?
Well, we're not experts on immigration policy. It's not really our job to comment on it. But what we do focus on is how immigration is affecting the economy and particularly the path for inflation. In the short term, immigration, any increase in population, particularly in an environment of constrained supply, is going to put a bit of upward pressure on prices. And what's happened in the Canadian economy over the last year is we had a particularly big surge in population growth through immigration. It came at a time when there was constrained supply. You can see this very clearly, most clearly really in the housing sector and in particular in rents. The policies that were announced are on their way to sort of relieving some of that pressure. We'll see how they play out, but we will keep an eye on that. It is definitely one of the things that's putting pressure on the housing components of inflation.
Et merci. Passons maintenant à Olivier Ferrand-Boissé du réseau TVA.
Bonjour à vous deux, merci de prendre nos questions. Avec l'effet retardé des hausses puis du maintien des taux élevés, quel est le risque que le portrait de la situation économique réelle, notamment dans les PME, dans les investissements privés, soit pire que ce que les chiffres nous disent présentement?
Nous essayons d'équilibrer les risques d'avoir une politique monétaire trop serrée avec les risques d'avoir politique monétaire pas assez serrée. Oui, il y a le risque aux deux côtés et vers la fin de notre rapport sur la politique monétaire, on discute les risques. Il y a certains risques à la hausse d'inflation. Comme j'ai souligné, nous sommes préoccupés de la persistance d'inflation sous-jacente. À l'autre côté, c'est possible que l'économie mondiale, l'économie aux États-Unis recule plus vite qu'on pense et plus faible qu'on pense. Et c'est aussi possible que la politique monétaire ici au Canada a plus d'effet qu'on anticipe. On pense que les risques autour de notre prévision est assez bien équilibré, mais on va regarder de près les indicateurs d'économie réelle et les indicateurs d'inflation en prenant nos décisions dans le futur.
Okay, we're going to turn now to Rachel Haynes of CTV, please.
Thank you so much. I just wanted to go back to the topic of shelter and housing right now. As you mentioned, shelter costs remain the biggest contributor to this above target inflation, but the Bank of Canada does have a direct impact on this, as when you set the higher interest rates, that is contributing to the higher mortgage rates as well. So if you're admitting to those shelter costs being that biggest contributor, why aren't you going to lower the interest rates now to get closer to that that target inflation rate and give Canadians some relief?
Well, a couple points. First of all, as Senior Deputy Governor just indicated, housing shelter costs, which includes housing costs, it includes mortgage interest costs, which, as you indicated, that is very much affected by the increase in our policy rate. We can see that. We can, we can look through that part, but rents are also going up very quickly. You look at other elements of housing costs, insurance, maintenance costs, they're all rising very quickly. So, even if you look through mortgage interest costs, you still see shelter overall is contributing importantly to inflation. And the other thing to remember is that, yes, housing is an important part of the economy. It's a very interest-sensitive part of the economy, and that's something we take into account. But, I mean, we're really looking at the whole economy, inflation across all goods and services. And shelter is not the only source of inflationary pressures. Food price inflation was extremely high, above 10%. It has come down, but at 5%, it's still too high. And if you look at services ex shelter, if you look at goods price inflation, yes, it has come down, but there are still some underlying inflationary pressures in various elements there. So, and you can see this, a couple clear ways to see this. Look at core inflation. That's stripping out the things that are moving the most, like mortgage interest cost. Core inflation's been running 3.5% to 4% for a number of months now. Look at the breadth of price increases. If you look at the share of CPI components that's rising more than 3%, that's slightly over 50%. So what this is telling you is that there's still underlying inflationary pressures across many goods and services. There's certain, inflation is still somewhat broad-based, and that's why we're concerned about the persistence in underlying inflation, and that's why we're holding our policy rate at 5% today.
Okay, next I've got Greg Quinn from Market News, please.
Good morning. I want to ask exactly about core inflation. There's a lot of focus on it in this decision. What kind of core trend inflation rate would you be comfortable with before there could be a turn to lowering interest rates? Do you need to see core inflation maybe around 2% your target before you have that discussion, or would it just have to get somewhere inside the target band? Anything?
Look, I'm not going to put a specific number on it. We've used this. You may notice we've been talking about underlying inflation. So, what's underlying inflation? What I'd emphasize is underlying inflation is more of a concept than a measure. It reflects a number of things, particularly our preferred measures of core inflation. Those are certainly a very important element of what we're talking about when we're talking about underlying inflation. Those give us a sense of, what is the underlying trend in inflation. But we also look at other measures of core inflation, CPIX, exclusionary measures, CPIX food and energy, CPIX. Getting back to the previous question, we're also looking at the breadth of price increases. We're still seeing more than 50% of the basket is going up faster than 3%. So, those are some of the key things we're looking at as we assess the trend in underlying inflation. And, what are we looking for to have that discussion about lowering interest rates? We're looking for continued evidence that inflationary pressures are easing, and we're looking for clear downward momentum in underlying inflation.
I'm going to call in Najoud Al-Maliz from the Canadian Press, please.
Hi, Governor. Given there's been speculation about cuts coming in as early as this spring, how should Canadians take your comments today about the Governing Council shifting to conversations about when rate cuts could come through? Would Canadians be wrong to think that rate cuts are imminent?
Jude, the message to Canadians is, look, we know Canadians want to see prices stop going up quickly. We know Canadians want to see interest rates come down. So do we. We want to see inflationary pressures ease further. We want to be convinced we're on a path back to 2% inflation. And when we have more assurance that we're on that path, we can start discussing lowering interest rates. But we're not there yet. We're concerned about the persistence and underlying inflationary pressures. And right now, the Governing Council's judgment is that we need the policy rate at 5% to take the remaining steam out of inflation. The bottom line is, monetary policy is working largely as we expected, and we need to continue to we need to give it a bit more time to let it do its work.
Okay, next is Mark Rendell of the Globe and Mail, please.
This time last year or in March last year, when you announced a conditional pause on rate hikes that led to a lot of rebound in the housing market, quite a lot of froth that kind of emerged through the spring. Is there any concern that this kind of shift in language that you're announcing today around, unlikely we're going to see more rate hikes, now we're talking about how long it goes, is there any concern you could see a similar kind of rebound, froth in the housing market that could put your progress in fighting inflation at risk?
Yeah. You'll notice in the NPR, Mark, that's one of the risks we point out. If we see an unexpected surge in house prices, that would, as you say, put upward pressure on inflation. So it is one of the risks. It's not in our base case. You can see a return to inflation in our base case, and as the governor said, that's really what's guiding our decisions right now. But that's definitely a risk we have our eye on.
And our final reporter here in the room is Kevin Carmichael from The Logic, please.
I'm curious about how you're thinking about expectations. Your last round of business and consumer surveys suggested expectations are remaining elevated. Both of you have been out in the Canadian public for the better part of 2 years telling everyone that inflation is going to come back to 2%, but those people that message doesn't seem to be getting through based on the last batch of survey data. So could you comment on why that might be the case and just how you're thinking about expectations when making your decisions?
Well, I'd say two things, Kevin. First of all, longer-term inflation expectations have remained well anchored on the target. And I think that reflects two things. One, we have 30 years, 25 years of inflation targeting and a track record of bringing inflation back to target. And secondly, when inflation did surge, we raised rates very rapidly. And that has kept longer run inflation expectations well anchored on the 2% target. And that is certainly critical to helping us get inflation back to target. As you indicated, short-term inflation expectations, it's not surprising they rose quickly. Inflation rose quickly. They are coming down. They are not coming down as quickly as inflation, and they're not coming down in line with our own inflation forecast. And that is one reason why we are concerned about persistence in underlying inflationary pressures. That is a factor that can slow the decline, and so we are concerned about that. To get to your point, are Canadians, not listening to the message? I think what's happening is Canadians are going shopping and they're seeing food prices are still rising 5%. They're seeing their rent is rising, 7-8%. So they're still feeling the effects of inflation. And as I said, when you look across a broader basket We've still got more than 50% of the goods and services in the CPI rising just over 3% on average. So, Canadians are still feeling inflation, and we need to deliver. We need to, Canadians need to see we need to see it. Canadians need to see continued downward momentum inflation to be convinced.
Okay, that's it for here in Ottawa. We're going to go to the few reporters who have joined us remotely. I'm just going to remind you, please, on the line to come off mute only to ask your question, and then go back on mute as soon as you've finished asking your question so that everybody can hear the response. I'm going to start with Peter Armstrong from CBC, and then I'll go to Rob McClister of Mortgage Logic News. So, Peter, please.
Good morning, Governor. It feels like Canadians can kind of put the pieces together here that, CPI should be around 2.5% by year's end. The economy will slow but not dip into a recession. Markets are pricing in like an 80% likelihood of a cut by June. But do you think Canadians who have been clobbered by these rate hikes, do they deserve a more clear timeline of when they can expect to see some relief, and have some frustrations over previous messaging weighed on your decision to, your reticence maybe to provide a more clear timeline to them?
Peter, look, I think it's important that we don't give Canadians a false sense of precision. I think we are being very clear with Canadians the conditions under which we can start to discuss cutting interest rates. But I worry that putting it on a calendar is, it's a false sense of precision. We're going to have to see how inflation evolves. If you look at our forecast, what you see and what we've seen in recent months, we've seen this push and pull on inflation in recent months. We were down as low as 2.8%. We went up to 4. We're now down to 3.4. In the months ahead, we expect to continue to see this push and pull. There's been clear progress on a number of indicators. As I indicated, demand has cooled, supply has caught up. That is relieving demand pressures, corporate pricing behavior. I don't think it's normal yet, but it has certainly been normalizing in a fairly sustained way. At the same time, inflation expectations remain, they're coming down, but they remain, short-term inflation expectations remain high. Wage growth continues at 4 to 5% inflation. The labor market has come into better balance. We are expecting to see wage growth moderate, but we haven't seen that yet. So, you look across the indicators, they're somewhat mixed. The progress has given us confidence that the rate is high enough. The unevenness, the persistence we're seeing has us convinced that for now we need to hold where we are.
Thank you. I'm now going to turn to Rob McClister.
Good morning, Governor and Senior Deputy Governor. The Atlanta Fed projects U.S. GDP to come in next around 2.4%. Which is pretty decent given how high rates are. And some of that U.S. strength is going to flow over our border. How much is the resilient U.S. economy and residual U.S. fiscal stimulus creating more inflation risk here in Canada? And if U.S. GDP were to continue around 2% throughout this year, how might that affect the chances of a Canadian rate cut this year?
I think what you want to look at for Canada is look at, growth of GDP in Canada. And yes, the U.S., and we mentioned this in our report, the U.S. has been stronger than we expected. Nonetheless, GDP growth in Canada stalled around the middle of last year. And we continue to expect flat growth through the first quarter of this year. So with that weakness in demand, we've already seen supply catch up with demand. And so, we think the economy is now in modest excess supply. That should reduce those inflationary pressures. So look, the U.S. economy is a very important economy for us, and our exports to the U.S. are an important source of demand, but there are, the biggest element of demand in the economy is Canadian consumers, and we have seen the impact of higher prices and higher interest rates has reduced spending by consumers. You can see in the data they're reducing their spending, they're looking for lower cost alternatives, they're looking for ways to save money. That is not easy. That's been difficult for Canadians, but it is relieving the price pressures that we've seen in our economy.
La prochaine question vient de Philippe de Montigny du Radio-Canada.
Bonjour. Donc, je voulais vous poser dans quelle mesure, and if you can answer in English and French as well, dans quelle mesure êtes-vous préoccupé par la forte hausse des prix des conteneurs, la hausse du coût du transport de marchandises avec les récentes attaques en mer Rouge, la sécheresse sévère au canal de Panama? À quel point est-ce que vous êtes préoccupé que ça puisse exacerber le rebond de l'inflation au Canada et possiblement retarder une éventuelle baisse des taux d'intérêt?
Certainement, il y a des risques à la hausse d'inflation. Il y a encore une guerre Israël et Gaza. Si cette situation devient plus grande, on peut voir une forte hausse du prix du pétrole. Comme vous venez de mentionner, il y a certains problèmes de transportation, la mer Rouge, le canal à Panama. Jusqu'à ce point, nous n'avons pas vu grand effet, mais si ces problèmes sont plus durables, s'ils sont plus sévères, oui, ça c'est un risque à la hausse de l'inflation. On a vu dans le passé, quand il y a des problèmes des chaînes d'approvisionnement, il y a un impact surtout sur l'inflation des prix des biens. Et donc, ça c'est un facteur, ça c'est un risque. On regarde ce risque de près. Il y a aussi des risques à la baisse. En gros, on pense que notre prévision pour l'inflation est assez bien équilibrée, mais surtout avec l'inflation en haut de notre cible depuis plus que 2 ans, nous sommes plus préoccupés des risques à la hausse.
En anglais?
Oh, oui, in English, sorry. Yes, you've highlighted some of the upside risks to inflation. Just to add to that, the war in the Middle East, if it were to escalate, it could have a larger impact on global oil prices. You could see global oil prices go up sharply. That would certainly boost inflation. The transportation issues that you raised, attacks in the Red Sea, shortage of water in the Panama Canal, those are raising the cost of transportation. So far, we haven't seen a big effect, but the longer those last, and certainly if they become more severe, that could start impacting transportation costs. And yes, we could very well see that in the price of goods. And these are risks that we highlighted in our monetary policy report. There are also downside risks to the inflation outlook, and overall we think the forecast we published today is reasonably well balanced in the sense that the risks on the upside and the downside roughly balance off. We're going to have to see how things evolve, but I will say, with inflation having been above the 2% target for more than 2 years now, we are more concerned about the upside risks.
Okay, next I'm going to call on Max Sato from Mace News, and after Max, I'm going to call on Amber Kanwar from BNN. Max, please go ahead.
Good morning, Governor. There is some sense of optimism in many stock markets, probably because the U.S. economy has shown some resilience. Do you think that is a positive factor for Canadians when the economy is slowing, or do you think it's going to work against your efforts to bring inflation all the way back to 2%?
I'm glad that there's some optimism among Canadians. Look, I think monetary policy is working. We're in a difficult phase of this monetary cycle. Inflation's still too high, and Canadians are feeling that. Interest rates are high, and as we've had to raise interest rates. We've indicated today that we need those higher interest rates to stay where they are to squeeze out that last bit of steam in inflation. So it is a difficult phase, but I do think we will get through this. I definitely think it will be worth it. I expect that we will see inflation coming down, growth will be picking up, and as we gain that assurance that inflation is coming down, yes, we can talk about lowering interest rates. So yes, there is certainly room for optimism.
Okay, Amber, next question, please.
Good morning, Governor Macklem and Governor Rogers. I kind of want to ask the question about rate path the other way. Most economists reacting to today's decision to hold for however long as kind of just a pit stop on the way to rate cuts. Is the risk of a rate hike zero right now? Should Canadians and businesses like a hike is not?
The risk of a rate hike is not zero, and indeed, in the opening statement, I was clear that if we saw renewed upward pressure on inflation, if we saw inflation going back up, and we thought that was going to be durable, yes, we probably would have to raise rates further. There are, we've talked about some upside risks, and if we saw those materializing, if we saw those feeding into higher generalized price increases, yes, we may need to raise rates further. I think the message today, though, is that's not our base case. We've become, with the progress we're seeing, with the economy moving into modest excess supply, with the labor market coming into better balance, we think pressures on inflation are coming down, and that has made us more confident that we've raised the policy rate high enough to restore price stability. But more confident doesn't mean there are no scenarios where we have to raise rates further.
Okay, I'm given to understand that we've got two people on the line, and I'm just going to give them, before we wrap up, an opportunity to ask the question. Barbara Schechter of the Financial Post, if you would like to ask your question, please come off mute and do so now.
Hi, thank you for that. I'm not sure if this has been covered. It's been pretty wide-ranging, but I wondered if you had anything to say about the contribution of government spending, and if that's been covered, bond prices, the bond contribution.
I didn't quite understand the last part of your question.
Oh, sorry. You can talk about government if that hasn't been widely discussed. The contribution was mentioned, and that's come up before, how important that is, and with a lot of elections coming up, I'm just wondering if you can opine on that a bit.
So we published our forecast today, and in that you can see our forecast for government spending. When I say our forecast for government spending really simply reflects the announced spending plans of all levels of government. And so if you look at the year ahead, when we add up the spending plans of all levels of government, that suggests real government spending growing between about 2.25% to 2.5%. Potential output growth, which is mostly population growth, we think is growing around 2%. So at 2.25% to 2.5%, it's kind of on the upper end of the upper end of that. So what that suggests is that if all those governments actually do spend all that, it's certainly not going to help us relieve inflationary pressures. It's not seriously getting in the way, but if governments were to add more spending on top of what they've already planned for this year, it certainly could start getting in the way. And particularly given that this is an important year to continue to make progress towards the inflation target, that would not be helpful.
And our last question opportunity, I'm going to see if Jeff Lagerquist from Yahoo Finance would care to ask a question. Jeff?
Thank you so much for taking my question. Can you talk about the Council's concerns about underlying inflation being elevated and the risk of cutting too soon? What would it look like if you cut too soon, and how much wiggle room do you have in terms of maybe if you cut one meeting too soon or two meetings too soon? Can you explain to Canadians what that would look like for the economy?
I think I've answered this question several times, so I can ask the Senior Deputy Governor to take this one.
I mean, look, we know you and Canadians would like us to give you a very precise single measurement that, a target. If we hit this, then we're going to start having a talk about rate cuts, or even better, to put it on a calendar. And I think, what the governor has been trying to explain to you, what our NPR and our opening statement are trying to say, is we just can't do that. We're at a point right now where we really, we always take the data apart in great detail, but we're really doing that now. There's a lot of push and pull, as we described. There's some mixed signals in there. We are more confident that we're getting inflation back to target. We're more confident we're on the right path. We're confident enough that we didn't spend a lot of time talking about hikes to the rate this time. Really, we see a hike to the rate as being a response to something we haven't anticipated, something that knocks us off our base case. Where we focused our discussion this time is how long do we think we're going to need to stay where we are to be really confident that we've got inflation well on its way to target. And when we have that confidence, then we'll open the door to a discussion on easing our policy. But right now, we think we need to stay the course.
Okay, we got through everybody. I appreciate that. That concludes today's press conference. Thank you very much, Governor Macklem, Senior Deputy Governor Rogers, and thank you to all of you for joining us today. We'll talk to you next time.
Thank you.